So yeah, 2026, some update. Obviously, I just start with the usual disclaimer. It's for general information only, blah, blah, blah. Okay, so we'll just do a quick summary of the ATO first, just so you know where it's at and why they're being so nasty. The collectible debt at the moment is at 54 billion, but the actual debt is 105 billion. So that shows that there's basically 50 billion they think they're not going to recover, whether that's companies that are liquidating or bankruptcies or whatever. They're pretty confident that they can recover half of it, 54 billion. But of that, 35 of it is from small businesses. So hence why they are so nasty. And 24 of that 35 is basically from unpaid activity statement debt. So that's massive. That's why they're being so aggressive, I guess, in their recovery tactics. So in the last year, they issued 85,000 direct penalty notices, which covered $5.5 billion debt. And look, I've seen a few of these around. Obviously, the year before was like 20,000. So that's a massive increase. But one important factor is because they keep doing this is because a lot of people don't respond. But I think what we've discovered is a lot of the reasons that people aren't responding is because they're not getting them, because they actually go to the address that the director has registered with ASIC. So it's not the address that we've got on your tax returns or your business, the ADR or anything. It's a total separate one again, which is ASIC. So unless you're telling your accountant to update your address when you move on ASIC, or when those annual reviews come through that get sent through to you and you're supposed to notify of any changes, but a few of those come back with no changes even though they have moved, then this is where you can get caught out. So that's just part of the aggressive moves that the tax office are on at the moment. In particular, they're targeting all the working from home claims, so car expenses, self-education, tools, equipment, uniforms. These are all things that they'll look at going forward, which we'll go over. And then rental property deductions. That's one of the highest risk areas. And given what's going on in the budget and everything, I don't know that you want to have rental properties anymore. Anyway, so that's basically a feel of where they're at and why they're being so aggressive, and apparently why the budget is going to somehow miraculously help the country. So we'll just go through on a few of the things that maybe you haven't picked up on, because I know you've all heard of the terrible, nasty stuff. Now, there is a loss carryback now for companies. So that's eligible companies, which would pretty much be everyone. It's like turnover less than 10 million or something. You can use the current year losses to claim a refund against taxes paid in the last 2 years. So if you remember, we had this maybe 4 or 5 years ago, just around COVID times, which they took away, and they've obviously brought that back in. And along the lines, which hasn't been nutted out yet, but it's announced, is there's also going to be some kind of loss refund for new companies. I'm not quite sure how that's going to work because you haven't paid tax, but theoretically, if you start in your first year and you make a loss, theoretically, I'm not quite sure how, you'll somehow get something back, or they'll do something with to refund something. Electric cars, the FBT exemption, that's still there, as long as the car costs under $75,000, and that's going through till the 1st of April 2029. So that has to be a fully electric car, it can't be a hybrid. But as long as you've got a full electric car under that, then you don't have to worry about FBT. The 30% tax rate that's applying for trusts, yay, from 1st of July 28, that won't be refundable to beneficiaries. Now, this one hasn't actually gone through legislation yet, and they are making some changes. Even today, they made an announcement, because everyone was complaining this is essentially a death tax on testamentary trusts. They are making some concessions on that after consultation, and that will be something, it'll have to be definitely only to individual beneficiaries, and we'll have to set up for that purpose. Once someone passes away, that's what it's for. So there will be some carve out for that. So hopefully that doesn't. So, they've essentially got rid of what everyone was saying is now going to be a death tax or wealth tax. The negative gearing limited to new builds, and the CGT discount abolished, and the minimum 30% tax on CGT. So the negative gearing and the CGT discount, 50% discount abolishment, that has already passed the Senate, and now it's gone down to the House, or the other way around. It's done the first one, it's now gone to the second House. And obviously it needs the cross-references and the other people to help approve it, but I'm guessing that one will get through pretty straight, because it's pretty straightforward, really. There are some changes with the CGT discount, again, that they announced today. So the startup, I'm sure you've all remembered or would have seen people posting photos with Albo going, oh, here's our new 47% shareholder in our business. You know, if they start up and because he's going to take half your tax, well, there's definitely an exemption there now. They're pulling that out for startups. So if you start up with minimal capital and you haven't used a lot of money, then that will now be incorporated into the small business tax concessions for the CGT. So that's good, but again, it hasn't been passed through yet. The only ones that are close to getting passed is the negative gearing and just the 50% discount. So the trust stuff with the 30% and even the minimum tax on the CGT, they're looking at that as well for people that are on certain benefits, so that they don't have to pay the 30%. And things like when you pay donations, if you pay, which is normally a tax deduction, they're allowing that to reduce your minimum 30%. That you would normally have to pay straight on the capital gains regardless of any other income. So there are still a few things. So it's good to see Power of the People has worked. All these things have got through. So there are some things changing, but again, until it comes through, we don't know all things they're trying to do. What else have we got? $1,000 work deduction without receipts. But that will be just 1,000. There'll be nothing else. So you can't claim car, can't claim phone, can't claim. It'll just be an incumbency. I have no receipts. I've kept nothing. I'll just claim $1,000 deduction, which can be handy for some people. This one's a bit weird. The Working Australians tax offset, like really, it's $250 that you'll get back on the offset, but you have to obviously pay tax because it's an offset. It's not a refund. So as long as you've paid tax and you're working, then there's the $250 back, which is legislated in there. So anyway, so that's pretty much the budget update. Love it or hate it. There's still a lot to go, and there's still a lot more consultation. They're still in there. They had the last 2 days. They're still in there now. So hopefully by next week we have some kind of answers. And like I say, I think we'll have the negative gearing and the 50% discount. That's going to pass fairly easily, I would imagine, with a bit of negotiation in the Senate. But the other ones with trust and the testamentary trust, we've got a little ways to go. So that's a separate bill. So any questions on that? No?
I don't think so, don't know.
So again, with everything the tax office is doing, try to be big brother, I thought I'd give you an update on the anti-money laundering and the counter-terrorism financing updates. So from 1 July this year, accountants are now subject to that, which kind of is not fun, because it involves implementing a whole new program. You've got to do due diligence, report suspicious matters. So now when you're on board clients, it's going to be a bit like the bank. You don't know your clients. You're going to have the identity software. You'll have to have the verifying all the owners, all the beneficiaries, all their details, countries, all that kind of stuff. Lots more record keeping and compliance costs. We've got policies and procedures, software to identify, detect it with the government. But the biggest thing is probably the reporting obligation. If an accountant has a suspicious or just have a suspicion or a niggling little thing that perhaps one of the transactions or client activities involves money laundering, big cash deposits, tax evasion, fraud, or any other kind of criminal aspect conduct, then they may have to lodge a suspicious matter report. It's SMR they keep referring it to. And more importantly, they're not allowed to tell the client that they've done that. It's a mandatory report that you would have to essentially dob on them, and you're not allowed to tell the client. Now, sounds wonderful in practice. I don't know how. And again, this has come from what happened up in the big end of town. It's pushed down onto everyone. But it is a mandatory reporting. It does affect people's licenses and all that kind of stuff. So I think it's very unfair that they're, making accountants a bit of a gatekeeper. And with the reporting, there will be some limits on it. So it's not like if you put through a dodgy $50 receipt, it's not like that's going to get you reported. It's more the bigger end of town, the totally blatantly dodgy stuff. And they're also trying to get rid of the, dodgy accountants that are doing the wrong thing as well. So, look, it doesn't probably reflect too much on taxpayers. It just means there's going to be more paperwork. Whole processing things are going to take longer. Look how long it takes to open a bank account sometimes. And it just means it's the only feasible increase really would be when you set up new entities now, because there's a whole heap of more checks and balances and obligations you have to go. Hence why I know there's a few we're doing at the moment. I said, oh my gosh, let's do them now before 30 June, before we have to go through the rigmarole of, the increased paperwork and the increased reporting that comes with that.
So, Di, just sorry on that. It's Dan. I know I've gone out to the owners and I know there's some reporting coming through to you. So, we had advised last week that we wouldn't be doing it till the 1st of July. I've gone back to the MDs to say, no, we need to now get the paperwork through for the incorporations prior to now the 1st of July.
Yeah. And I think I've spoken to most of mine anyway. So
you've spoken to them all now? Okay, great.
Yeah.
Awesome.
Yeah. Right, okay, so that's all the fun and games out of the way. Let's just move on to a bit more normal, stuff. Oh, what's going on? There we go. Business tax. Okay, so the tax rate's going to remain at 25% if you're trading, obviously, and 30% if you're not trading, as in your on income's passive income. Investment income, you pay 30%. Yeah. So that's no real change. Now, superannuation, I'm sure you've all heard it 1,000 times that payday super starting 1 July 26. And again, this is another one that the tax office have put in place. Again, if you go back to that $35 million debt that is owed on the activity statements, a lot of that, obviously, if that's not paid, it also means the super's not paid. So they just go, well, we'll get it straight away, then we know it's coming. And it will also mean we won't have to do the super guarantee statements anymore, which is good for any late payments. But what it will mean is the tax office use their automatic data matching. So if it is paid late, you'll just get an automatic bill for the extra, for any interest in the admin fee that you have to do. So I think, I know accounts have got it all sorted. They've been trialling it out for some entities anyway before already, so they know once it flicks over, it will be all hunky-dory. The only thing will be a bit of cash flow, because if you've got to start paying, say the first week in July, but then you've also got potentially some of June's super to pay as well. So, and look, the next step, the next obvious step will be for them to eventually bring in same day pay-as-you-go paying to the tax office. So large entities currently do that. Every time they make wages, they have to pay the tax withheld directly to the tax office. But I can just see that this will be the next one, because the super's getting paid straight away. So they consider, well, the tax should be paid straight away as well, the pay-as-you-go. So that's one for down the road. It is. I often find people that debtors are, there's been some old ones sitting there, or old loans on the balance sheet, things like that. So just make sure you go through and clean them up, because you don't want to be paying tax unnecessarily on, on income that you're never going to collect. So you're better off just writing it off. Look, you can do the standard things like prepay your expenses, some rent or some interest, depending who's on the other end, if they're happy to take it, because obviously it's going to be income to them. But that, to shift the profit into this year rather than next year. I always suggest to do a new logbook, even if it's in the car's if you have a car in your name, or if you have it in the company name, just because if your kilometres increase, then you're obviously going to get a bigger tax deduction. So it's always worth doing a new logbook. I know technically you don't have to, it lasts 5 years. And if you don't have one at all, you definitely need to do one. So at least you've got, a base that you can use to start with. The instant asset write-off, that's finally been legislated as at 20 grand. It used to always be a budget measure and a temporary, but now it's actually finally gone through, or is going through, it will when that bill goes through, so that every year it will definitely be the 20,000. So any asset you buy for the pump company less than 20k, you can depreciate in full. Your director's loans, need to keep an eye on, either repay them or repay big chunks of them. Otherwise, you'll have to get a Division 7A loan agreement in place so that you don't fall foul of the 7A and have a massive unfranked dividend to you personally. So that includes, with the record keeping, providing all your missing receipts. I was speaking to someone this morning who had like $77,000 in unallocated transactions. And I'm like, you realise that's like, $15,000 of tax plus, 6,000 GST that sort of be missing out on just because you're not putting that through. And particularly that's, going to end up going to you as an unfranked dividend. So please make sure you're looking at those. I know you get your spreadsheets emailed virtually every week from accounts with your unallocated transactions on them. I know lots of people, their admins use the credit cards because they book flights, accommodation, pay for advertising, whatever, which is fine. But you should all have a policy in place with your employees that are using your credit card that, basically states, anything you put on my credit card, you need to have the receipt for. Give them the DEX email and they should be sending it straight through whenever they do it. Otherwise, it's essentially considered theft. It's not their money. So they need to account for everything they've spent. So if they're using your card on behalf of of you, of the company, then you need to make sure you've got those checks and balances in place. But it has added up, and over the years, people have lost lots of money on that. And same with travel diaries. If you've got travel diaries, if you're paying, even if you're not paying travel allowance, just the fact to prove that it's a business trip that everyone's gone on, they should be doing travel diaries to prove that they've gone for business reasons and not private. Yeah. So individuals. So a couple of things individuals can do. You can consider paying extra super personally. I know I've had a few conversations with some owners about paying extra into their super. So as long as your balance is under $500,000 in the prior year, you can top up your super with certain amounts. Basically, you can put 30 grand a year, but if you haven't been putting 30 grand a year for the last 5 years, any difference there of what you could have put in, so 150, let's say you'd only put in 50, then theoretically you could put 100K in this year as long as your balance is less than 500. So, and given everything that's going on with all the other investments at the moment, that seems to be a good, safe kind of investment. It's still only paid 15% tax. Yes, you can't get it till you're 60, but it's still put away, and we all know how compound interest works, and obviously that's worth a lot more the younger you are, which most of you are. It can give you a much better return. Look at your capital gains tax and losses. I mean, obviously you're not allowed to have wash sales, so you can't buy something today just to crystallise the loss, sell it, and then buy it straight back again, sort of for the same price. You're just doing it to crystallise the loss. You can buy different shares, of course, though. So you could sell one at a loss to counteract if you know you've got gains coming and you want to balance it out, and then just buy something else. So just don't buy the same share, because that's considered a wash sale, and the tax office will get you on that. And over there's data matching, so they can see every share you buy and sell, unfortunately. So yes, they know that, so there's no hiding from them. Working from home, if you're going to work from home, you need to have a diary record of the hours. So you can't just go, oh yeah, I work 6 hours, or I work full time from home, or I work every Monday 7 hours, or 2 hours a day, whatever it is. You're supposed to actually keep a diary record of that. So whether it's on a pretty spreadsheet, or whether it's in your diary or in your phone at the end of the week, however you want to do it, you need to actually record the hours that you've worked from home, assuming you want to claim any deductions. Although, given they're bringing in the $1,000 automatic deduction, potentially, maybe that will counterbalance that, and it won't really matter if you don't have it, because generally it comes up anywhere between $800 and $1,000 anyway. I guess it's not as critical anymore. Just make sure you've got your receipts for all your deductions so you don't forget. Again, I've got there doing your logbook. Consider deferring any income next year to take advantage of the lower individual rates, because it is going down slightly. But again, that's probably only with capital items that you might be able to do if you want to force some capital gains or losses. And if you own a rental property, you're going to have to do a valuation at 1 July 2027 for the new CGT changes. So I imagine that business valuers are going to be absolutely smacked around then. So, I mean, obviously you can't do it yet because you haven't got there. And you can obviously do valuations after the fact, and they can go back. But the further you go backwards, so if you didn't do it till 2030, so the more chance the tax office will go, nah, we'll just lower that a bit just for their own sake, just to be able to get more money, when it came to the CGT. So, all right, so the tax rate, individual tax rate. So these are pretty much the same as last year. 2005 and 26 are the same. Same tax bracket, 16 cents. So the only change going forward from 1 July is that first tax bracket. You can see it goes to 15 cents in the dollar. So, it's $230 if you earn over $45,000. And if you're under, obviously, it can be the same. So that's something that they did, I don't know, about 4 years ago. Every year it's been going through. This is one of the last changes to update that. And then the last thing I want to remind you of, which is everybody's favourite, payroll tax. Given the nature of everyone and, all your wages and everything, we have lots and lots of companies that now fall under payroll tax. So the way the payroll tax works is it's state by state. So I've got all the states there and the annual threshold. So if you go over that threshold, then you're going to pay a percentage, the rate of every dollar over that threshold. So, and it's your wages plus your super. Add the two together and you'll go over. And that's a lot. So accounts, again, are pretty good once they get to it. Once we've seen where it's at, they'll start provisioning it for you until we actually register and start paying. But that's just something to keep aware of too when you're doing your budgeting and your cost per piece per guy or whatever. If you're if you're paying lots, you need to make sure you account for that extra, whatever it is, 4 or 5% on top as one of your wage costs. Yeah. Well, that's all I really have, unless anyone has any questions.
Fun and games.
Yeah.
Yeah.
Fun and games, as usual.
Thanks, Di, for going through that update. It's actually good to, irrespective of the end of the year, just what's going on in the market anyway. But I don't know if you remember this, Di. I was laughing when you started off with the budget, because I'm very attuned to the budget these days when it comes out, because it has a big impact on small businesses. And your points at the start about small businesses and the impact it has on the national debt is just mind-boggling to me. I'm just going, oh my God, that is just horrible. But
Yeah.
it's a fact of life, So it just made me think how grateful I am to be in our situation. But I remember the budgets when I was growing up, and I had a different take on it, because the budget used to be this. It used to be announced, cigarettes are going up by 50 cents a packet. Beer will now cost you $1.45 a schooner at the pub. And that was the big thing. And what was the other one? It's probably I'm trying to think. Petrol prices are going to go up by an excise of certain. So everybody waited for the budget to find out how much the beer was going to cost them, how much the cigarettes were going to cost them, and how much your petrol was going to go up, because that's where the government made its money.
Yeah.
You don't probably hear that as much these days. It's just now all about small business. So I had to laugh at that when you were saying that, guy. I'm thinking back in my day, and luckily I didn't smoke or anything like that. But anyway, logbook. Can I ask, Di?
Yeah.
I know you harped on me because I'm getting another car at some stage, and Shane, you got to upgrade your logbook. Come on. So I went and downloaded the digital logbook. Is that sufficient?
Yeah.
Okay, so I just have it in the car, a little tracker in my car, and it just logs everything for me. So I don't have to do nothing. Yeah?
Yeah.
Okay. I don't know if anybody else has a problem with keeping details like that, but I'm not big at that. So I kind of wanted to ask that for myself. But for everybody else, your travel diaries, your logbooks, loan agreements, not that most of you guys will have loans out, but if you're taking some funds out of your company, having the appropriate documentation for it, prepaying expenses, if you can prepay some expenses to write off against your margins you made this year is always a good thing. Writing off assets. Di, I bought a new laptop the other day for one of my staff members. Can I write that off? Yep. Okay. That's cool.
20,000. Anything less than 20,000.
I hope not, because only a laptop. If it's over 20 grand, I'm going to be unhappy.
Like you bought everyone a laptop.
I did get an iPad though. That might be 20 grand. And maintaining all your receipts. It's probably a bugbear for everybody, but retention of your receipts is really, really important. I used to go, oh, it's on my credit card. Everything's on the expense set. No, you need the receipt with the credit card. And I know I travel a lot and move around a lot, so I know Amy, who does my reconciliations, always going, I've got this payment, Shane, but I've got no receipt for it. Where is it? And I'm pulling things out of the bags, out of the cars and stuff like that. And that's a real issue for her. But to make her life easier, I got a little receipt box I keep at home and run at the office, and everything just goes into there on a regular basis. So I then give it to her, and then she's got to then decipher which is which is another task in itself. But it's the way I do it. So I'm just going to just encourage everybody to make sure that you got those checks. And the balanced credit card one you mentioned about having any staff that use it. If you have a company credit card, that just needs to be documented that they can use it. Is that what you were saying?
Yeah. You should have a policy in place, because to show that they're, one, they've got authorization to use it, and two, that anytime they do, they need to produce the receipt for it. Because if they're paying for something, they get the receipt, right? They book your flights, they do whatever. It should come through to them. So then they need to make sure that that's going through the Dext.
Yeah, like not a nice thing to say, but I know there's been stories where people have
Yeah.
had theft internally from their staff over the years, because they've got access to an account or a credit card. So you just got to be conscientious of it, that there's a record for it,
Yeah.
and so forth. So I thought I'd highlight those. So, but I didn't have anything else to add to that, Di, but that was just things that were front of mind for me because I'm dealing with some of these things myself right now.
Good. Look forward to getting your logbook, Shane.
It's on there. It's on there. It's on the app.
Okay, good.
Any questions, guys? Thanks for hanging on. I know it's been a long call today.
I had a quick one, Di, if
Go
possible.
for it, James.
Yeah.
Go.
It was just going to be around the work from home. Like, obviously, we do rosters and stuff like that. Does that classify as work from home, so we could log that? Like, how does that work?
Yeah, so is your roster including hours that they're working from home?
No, I mean, like for ourselves, like, obviously the work that directors do from home, does that classify for us as
Oh,
work from
yeah,
home
it
for us
does.
to claim?
Yeah, absolutely. Just keep a record of it, of the number of hours. Yeah.
Yeah. Cool. Thank you.